Welcome back, my dear friends. So far, I hope the journey is going good. Till this point, any doubt you have, please write me, inbox me, and do not just switch over and what I will say, don't spoil my rating, please. I am just doing my best efforts to make you understand the concepts in a better way. Sometimes students are not feeling good. After seeing the first lecture only, they start giving one rating star or something, and they give very negative feedback. And that is really demotivating. If you have any sort of complaint, write me. I will try to improve in my next video. Alright. So this is about flow. So understand this portion very clearly. This is very important for us to understand. When we talk about the flow in a balance sheet of the company, we have different parts. Non-current assets, normally we call fixed assets or long-term assets. Current assets means 1 year components. Non-current liabilities like shares, debentures, bonds, and current liabilities as we discussed. Now we have to see what kind of flow can take place between these items. Let us see. We have fixed assets like building, like machinery, equipment. I am just taking some examples, so don't feel bad about it. We have current assets called account receivable, stock, prepaid expense, cash. We have current liabilities, accounts payable, loan short term. We have non-current liabilities like shares, or we call it stock. We have debt, equity and debt we can also say. We have long-term loans. Now understand it like this, that if you sell building, do you get cash? Yes. So means by building there is a possibility of cash flow. Yes. If you buy building, cash. Machinery, if you buy and sell, cash will be there. Flow is possible. Equipment, flow is possible. So this is the only helping us to understand whether the flow is possible between the item or not. Now next, account receivable. If you get money from your account receivable, what you get? Cash. So means flow is possible. Stock, if you sell stock, cash flow is possible. But if you sell stock on credit, there is no cash flow. It is a non-cash flow. So that will go in fund flow. Prepaid expense, this we have already incurred. So we only get service. So when we incur, that time it is happening. But right now, flow is not possible. Cash in itself we are finding it, so no need to consider it. Shares, when you issue shares, you get cash in the bank balance. Debt, you increase debt, you get money. You pay debt, you give money, outflow. Long-term loans, if you raise long-term loans, you get money. If you pay long-term loans, you pay cash. Current liabilities, accounts payable. Now understand this jargon very clearly. Money not spent is money earned. I repeat, money not spent is money earned. So when we take goods on credit, at that time we save money in our pocket, so there is a flow of cash inflow. When you pay to the creditors or accounts payables, you pay cash, so there is a outflow. So possibility of flow is there. And loan short term, possibility of cash flow is there. Now the question arises, why I am discussing all this? The discussion is very important, because you need to understand that in cash flow, in every item of the balance sheet or income statement, you will understand flow is possible. And we discussed in our preview part in the first lecture that flow means change, and change means inflow or outflow. Inflow means when the money comes, outflow when we spend. So inflow and outflow is possible in almost all items. And when it comes to analysis, we have to understand where we have spent more, where we are getting more. So from the sources where we are getting more money, we can spend more money for the development of that source. Where the money is getting waste, we have to control that. That is the only purpose of cash flow statement analysis. So in our next lecture, I am going to start with different activities of cash flow statement. So once we are going to be through with all the activities, I will take you to the live demo where we will discuss about some balance sheet, how to take out the cash flow statement, how to understand that, and how to evaluate that over a period of years. Not year, years. Because 1 year cash flow statement is not helpful at all. We have to compare it with the previous years. So stay tuned, stay with me in the next video where I will explain you activities of cash flow. Alright, thank you very much.